Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City, and I am here to bring you the our anticipated trading levels for the coming week of September 18th, 2023. Before I do that, I do want to bring the ubiquitous disclaimer into play here. Precision Trading Labs, we are not financial advisors. We are not fiduciaries. We're not brokers. We're not money managers. Everything that we bring here is for educational and informational purposes only. All right. So the game plan, the agenda here is I'm going to cover the major market indexes, the big cap indexes, the SPY, which of course is the S&P 500, and also going to cover the QQQs, which is the Nasdaq 100 index ETF. I'll then follow and do the cover the Russell 2000 index, which is the IWM ETF, and then lastly we'll take a look at Apple. So that's the agenda here today. All right. So let's take a look at the charts. So here's a look at the SPY. We're looking right here at a daily chart of the SPY here. And so this is where we closed on Friday, 443.4 or so. And so what we're looking at here, this is a daily chart. Here's where we closed on Friday. After a good drop there, about 1.5%. You can see we dropped about seven S&P points here. There was obviously a big gap down from this area right here, which was Thursday. There was obviously a gap down to there, and then of course it continued on down. All right, so that's where we closed on Friday. At 443.5 or so. So what we're looking at here is these are the levels that we've kind of laid out for the forthcoming week. So first of all, if we look down here, this is an area where there's a fair amount of trading in here. But if you notice right here, there was a reversal here. A few days before, there was a major daily candle down, a consolidation that right there on the next day. Okay, and then notice that right there was a pop there, and then a very, very bullish candle that came out of here. So one of the things that we're looking to is when this thing pulls back into here, there is this right here, supply and demand for shares. They were kind of in sync there, and then obviously right there was an exhaustion of sellers here. The sellers essentially moved up the price chart, and the only reason that these sales occurred, these trades occurred, is that the buyers ran up the price chart until they encountered willing sellers. So when you get a pullback to this region, we can expect under certain circumstances to then see another pop out of this region. So right here, this is actually a very short distance down. This is only about 3.5 S&P points down, and that's a little less than 1%, 0.8% from where we are now. Okay, so that's one trading area. Now I have to say, this is really not a prime trading area though, because of the fact that we've had all of this trading that preceded at this level. Okay. And price never really kind of broke this level. It broke it very slightly here, then it came back, it came back quickly here. So this was really more support than clean demand here. And so as a result, I'm not necessarily in love with this level here. Price could pop from here, but this is not an A plus or an A level. Okay. On the other hand, if we look further down here, right in this area where there's yellow here versus the orange up here, if you notice right here, price rallied there, consolidated, and then kind of popped from there. And notice price has not been back there since. Okay, this is a clean area of demand. Okay, and so just to clarify and to define the term here, this is what's referred to as a demand zone here. And as I have put sitting here on the right here, a demand zone is an area of expected upward price pressure created by, and then there were basically three criteria. First of all, you had an energetic move out of here. This exit, okay, was abrupt and very energetic. So that's one criteria, okay? The second criteria is that there was a clear period of sideways price action for a relatively brief amount of time. Okay, so this didn't go on, for weeks, or I mean, it did go on for 3 or 4 days, but if we noticed that it kind of stayed very much sideways in there until we had that explosive move out of there. Okay, so that's the second criteria, and this was all created by, again, an exhaustion of sellers. Right here, supply and demand were in agreement; they were in sync. And then after that, they went out of sync. Okay, essentially the supply of shares, or the essentially willing sellers, left this area. They were no longer willing to sell here. And so all of these transactions occurred, all these trades occurred when the buyers ran up the price chart until they found willing sellers. So what we're looking then here is, when price gets back to this level, this is really the level where we have a good deal of confidence that we can get a high probability positive expectation trade from here. Okay, and so technically the price could pop from this little region here, but if we get a pullback here, I would not be at all surprised to see price kind of drive through this level because of all of this trading that occurred here. And so what I'm really looking for in the prime level is there, okay, and that's about 3% down from where we are, where we closed on Friday. Okay, so we would need approximately about a 13 S&P points to come off here from about 443 down to about 429 or 430. But this is really the prime quality level that we'd be looking to execute a trade with a bullish bias. So this is where we'd be looking for a pullback. In other words, the buy the dip, essentially, back to here. So this is our quality level here. All right. So that's where we are on the bullish side. On the bearish side, what we would be then looking for is a rally up to a level of supply. Okay, where essentially essentially an exhaustion of buyers in this case. So right here, price was up here, okay, went sideways here for these 3 days, and then notice price gap down, a relatively bearish candle, excuse me, and then price kind of over the next several days just kind of drop from there. This would be an area where we would have an expectation of future downward price pressure, where we could execute a bearish trade. Okay, and so right here, this is essentially the same thing as demand, same narrative, except of course turn it on its head. So this is an area of expected downward price pressure, and this is created again by an exhaustion of buyers here. And again, price spent a relatively small amount of time here, and then right here, of course, it was essentially an abrupt, very bearish move out of this area after this brief area of consolidation. Okay, so this is an area of supply, and this is where we would have an expectation that we could take a trade with a bearish bias. Okay, and so right here, this is about 12 S&P points above where we are now, about 2.5%. Okay, so essentially the prime trading ranges for us, where looking at the SPY, is more or less kind of 2.5 to 3%, either up or down. Okay, so the SPY level again is up here about 2.5%, and the demand level down here is down about 3%. Okay, so that's the story for us with the SPY. If we now turn to the Qs, okay, so here we are looking at the Qs here. Okay, and so here again, kind of the same story here. So right here, we had a rally, and then price based over here, and then we had a drop out of here again with that's really the same level here, with that bearish gap here, and then that bearish candle that followed. Okay, so we noticed though here, price came up here, actually kissed the front of this level once, and there was a drop here. Okay, and so when price comes back here, I'm still relatively confident about this level, because price only kissed this level here. There was barely any incursion at all. Okay, so this was a supply zone here, as marked by the SZ here. So there's the expectation that there is still really all the supply is still left in here, because again, the incursion here was extremely moderate. In fact, it was almost negligible, and for a very short amount of time. Okay, so this level up here is about 2.75% up. That's about 10 points on the Qs here. And so that's an area where we could take a bearish trade. Okay, down here, we have a couple of different levels here, and more or less there's a 2 hour level here, and then which is kind of sitting also on top of another level here. And this kind of, I would almost be inclined to treat this as one large level here. Notice price came down here, and then this kind of pivoted here, and then went up here. And if we change this to a 2 hour level here, and so I'll change this to we'll move to the 2 hour chart here. When we do that, we'll take a look at that level, and we'll be able to see clearer the consolidation here. So notice price comes down here, consolidates, pops, and then notice there's another area of consolidation, and it kind of pops from there. Okay, so from where we are now on the Qs here, we're basically about 1% down. And again, that's a similar number to what we saw in that higher SPY level here. Okay, so this is about 1% down here, and then this other level that's sitting right below it, this is about another 1% down from there. Okay, that's about 1.8%. Okay, so this is the level where we're looking for a bullish trade here. And then again, for the bearish trade, I still like that daily level here that I just showed before. Again, price just kissed it over here. Okay, but really, obviously, as we can see, that's negligible there. And we probably only probably did it only for a few shares and like 3 minute, like on a 3 minute price chart or something. That's the entire level of contact there. So I'm still liking this level here, and that's about 3% up. Also, to let you know here, once you have these levels, and let's just say we're going to decide to do a bearish trade here or a bullish trade down here. Okay, how does what can one do? Well, obviously, there are different ways of what we refer to as expressing a trade. Okay, so we can express the bearish trade here in terms of the most, the simplest strategies. Okay, from a supply zone here, obviously we can. In fact, I have these backwards here. Forgive me here. From the supply zone, we can short the stock. Okay, so that's what we can do from supply. We can short the stock, but we can also then buy a put, which of course is another way to express the bearish trade. Okay, then another way we can express that trade is more or less to buy a put, but then also to sell a put beneath. Okay, and that's essentially what's referred to as a bear put vertical spread. Okay, and so we can do that, and essentially buy a put at a higher strike and then sell a put at a lower strike. Okay, and that lowers the premium and also changes the dynamics of the option trade, which in this case would be referred to as a spread. And then lastly, a way of collecting credit would be to sell what's referred to as a bear call vertical spread. Okay, in that case, you would sell a call somewhere above, and then you would buy another call at a higher strike. Okay, and then buying that call at a higher strike reins in the risk. You're not just selling a naked call at that point. And so that defines your risk. And of course, your risk on that kind of spread would be the difference in the strikes. And then from that, you would then add in the premium that you collected. So if the difference in your strikes was, let's say, $3 and you collect 70 cents of premium, well, then your max loss, of course, then would be $2.30. Okay, as opposed to a naked call, which of course would theoretically have unlimited risk. All right. So, and then on the demand side here, and again, forgive me, I have this backwards here. So on the demand side here, of course, you could obviously buy stock here, and then you could, or you could buy a call down here. And then same way that I explained this up here, it's just turn that on its head. So we could do a bull call vertical spread. Okay. And you would buy a call. Okay. And then you would sell another call at a higher strike. Again, so that's a debit spread where you're actually paying to play. And then lastly, you could also collect premium by doing a bull put vertical spread. And again, you would sell a put at a higher strike, and then you would buy one at a lower strike, again, to rein in and define the risk. And in the case of those spreads, for the simplest of the strategies, we're using the same exact expiration date. There are other ones where you'd sell a call you would sell a longer duration call and then you would buy you would sell a shorter duration call, and then you would buy a longer duration call, and that changes the characteristics of that. Okay, so that's what the deal with the Qs. We could also then talk about the IWM here for the Russell 2000. Wait for that to change. There we go. So here's where we finished on Friday. Up here, this is actually a very, very small time frame here. There is actually a 30-minute level in here, but again, that's a very, kind of a small time frame, relatively speaking. So I would not be, necessarily jumping to do that. Plus that was actually hit here, but we can see price came up, consolidated. We're now looking at the 30-minute chart here. Notice there's a big gap there and then a major bearish candle there. So price came back here, stuck in there, okay, and then it kind of hovered there for a day or so, and then eventually dropped out of here. This is kind of an iffy level, though. We're really not in love with it, okay? And then after that, there's really no clean demand here. Right up here, you have what we can think of as a resistance zone. Let me just change this back to the 2-hour chart here. Right here. So we can see right here, price came down, consolidated, and then price came back here once. So we can think of this as kind of resistance here, but it's really not clean demand. And in fact, the real next point of clean demand, clean supply, is way up here at 196. Okay. So right here we're sitting, we had closed here at 183. So in terms of the Russell, the next place that we really think there's a quality short is probably about here, okay, and that's about 7% up. So that's a long way up. So I'm really not looking, I don't expect to see any kind of major bearish trades that we can exploit on the Russell in the short term. Okay. On the other hand, for the Russell, if there is a pullback, then in fact, here's what we're looking at here. This is an area of kind of support that got created a while back. And right here, we can see also there's been some support here. But this is not clean. There's really not clean demand here. We can think of these levels here as more support. The next level of clean demand, though, is right here, where price, spread that out a little, okay, price dropped, consolidated, and rocketed out of there. And essentially, we have not been back since. This might have actually kind of grazed the front here, but we really have not been back to this level since. Okay, so right here, this is about a little less than 2% down, about three Russell points down from where we are now. And so that's the level right here where we're actually looking for, if we get a pullback, again, to express a trade with a bullish bias right here. And then right down here a little further, there's another level of about below, and that's about here. And that's about another 1% down from there, and that's about 7 Russell points down from there. So the near-term level here is about 3.5%, 3.5 points, about 2%, and then this other one is about 7 points down, and about a little less than 4%. Okay, so that's what we're looking at on the Russell. And then lastly, let's take a look at Apple. So let's just spread this out a little here. Okay, so right here we have a rally, price rally based. Then notice we have that abrupt, very bearish move down. Okay, and now this is where we're sitting now. So if we get a rally back up here, which is about a little less than 2.5%, this would be an area of where we could expect to take a trade with a bearish bias. And again, we just explained a couple of slides ago the various ways we can express that trade. Okay, so that's the bearish level on Apple. And then in terms of the looking at a bullish trade, right here, this is an area of prior demand here. So we had right here we had a clear rally and a base, and then a pop out of there. Okay, so this was demand prior to this. Okay, so then price returned here, tested that level, and then we got a rocket out of here. Okay, and in fact, we ended up having a very nice trade that came out of that based on that prior level from right there. Okay, so we ended up with a nice trade that came out of here. But now, since then, price has been back here multiple times. You got another pop out of here. We did not take this trade because we generally only take a trade out of demand once. We have an expression that the first test is best. Okay, so this was the first test. This is a retest. As it turned out, it worked very nicely, but we didn't do it. And then ever since then, price has now kind of bounced along the top of this prior level. So at this point, price started out here as demand, and it was demand, but now it's been tested and retested again. So now we can think of this level not as demand, but we can think of this as support. And we think of this now as a support zone, okay? So this support zone is sitting, a very short distance below. In fact, we're really kind of sitting right on top of it. But the next clean level of demand here is obviously now under here, and that's about 5% down, and that's right here. Price came down, rallied, popped, and if we notice now, price has not been back there since. So this is what's referred to as a clean, fresh area of demand. And again, we can express a bullish trade out here. All right. So that's what I got for the four symbols here. So we'll be doing this again next week. So, but in the meanwhile, if you like what you saw here and you found it interesting, we'd appreciate it if you would give us a like, subscribe to our channel, and also you'll see in the link in the description there is a link where you can schedule a call, and I'd be happy to talk to you about further about supply and demand. I'd be happy to talk to you about how we can kind of use this. I'll be happy to talk to you about, give you a further explanation about these supply and demand zones. And again, one of the things that we can do with this is that, once we have these zones, that determines how we can create high probability controlled risk trades. And particularly with options, to use those levels to essentially decide on our entry points for those levels. Okay. And so essentially they lead to more efficient, better options trades. And so, again, I'll be happy to talk to you about that. All right. So anyway, this is Mitch Firestone. That's what I got. And thank you for the privilege of your time, and see you next time. Take care. Bye-bye.